Okay, folks, welcome back. We're going to be doing a continuation of the algorithmic order flow. Changes in the state of deliveries is part 2. All right, so we have our chart trained on the daily chart of the euro dollar. And we were talking in the previous lesson how we started our buy program right in here. And whenever we're starting a buy program, we want to be considering where it could trade to. So we're going to be working inside the range. So if we're working at a beginning point here and we're bullish, we have to consider this high to this low and where we're at in terms of the range. So we are extremely oversold without needing to have any overbought oversold indicator relative to this price point in here to here. If this was a box, if you will, we're in the lower end of that box. So we're very suppressed in terms of valuation, and it's considered cheap. So the algorithm has multiple price points in here it could trade to. From here, it could trade from here to there, and that would be the end of it in some instances. Or it could trade from here to here, or from here all the way back up into and above this high. Now I'm going to count you to go back and look at the commentaries around this time period because we were looking for higher prices anyway, and I gave you an idea how if I was making the market I would take it down below here and then start setting it higher up into the levels I mentioned in those recordings and in the previous lesson. We're going to counsel you to study this range high to this low, okay? And I want you to think about some of the lessons that you've learned in the core content. Now, I'm going to say some things here that may not have been covered yet by the month that you're at right now. So what do I mean by that? You may not have gotten to the levels of lessons and content and principles and concepts that I cover that I'm going to just go over here and in passing. In other words, I'm taking a lot of liberty and assuming that you are already familiar with this lesson. This is one of those lessons that you will understand more when you see the other lessons that teach more about the principles I'm going to cover here, okay? I want you to think about how this works together and how, from an algorithmic standpoint, the delivery of price is facilitated. Now, that's just a whole lot of mumbo jumbo for saying this is how your charts make the candles. Okay, it's a little easier to say it that way, but I'm giving you the inside track as to what's actually going on. But in layman's terms, this is how the market goes from where it is and where it's going. All right, so we're oversold here relative to the range high and low. We're down in the lower end. We framed out the likelihood of bullishness on euro, bearishness on dollar, and we could likely see price trade all the way up to and above this high. Now, what happens if we don't trade above the high? Well, that's fine. We have a PD array that works with that. That's the rejection block here, the highest up close. Okay, so we'll refer to that. We're going to refer to the last up close candle as the bearish order block and the mean threshold of that range. Okay, so with that in mind, we're going to be considering how, if this is the beginning, and we're going to use the rejection block because we're going to assume that it might not go back above this high. It could fail. So how do you frame probabilities around that and still find opportunities that don't require you knowing, because you're developing, you don't know for certain if it's going to take that high out. But what if it trades to that rejection block? Isn't that a handsome objective? Sure it is. What happens if it trades just to the mean threshold of that up close candle? Sure, that's amazing. How about just to the bottom end of that up close candle? It's fine just as well. So you have to look at where you are, and we're assuming we're trading here with the benefit of hindsight only for this lesson. But again, go back and watch the lessons and commentaries back then, and you'll actually hear me talking about how we're bullish there. Okay, so we're looking for the 3 PD arrays that are premium by nature. That means they are PD arrays above the market price down here if we're underlyingly bullish. as it is. In this example, we're going along with what we were looking for at the time. But I'm going to flesh out a few things here and ring in some things as well, so you can see how the algorithmic order flow works in concert with IPTA's PD arrays. So from here up to here, we're working with a bullish bias. So let's study how we can forecast likely areas where IPTA will create a change in the state of delivery. And how do we do that? Well, I teach you a concept in this mentorship called grading a price swing. And the yahoos all over the internet that are trying to make a name for themselves with my content or just credit me, they're trying to say that it's quarters theory, and it's not quarters theory. If you study quarters theory, you'll quickly see that what I'm showing you is not quarters theory. Quarters theory doesn't understand how we use the range low up to a range high, and then we split that in 25, 50, 75, and then terminus. Understanding that the IPTA PD arrays will have logical levels where we can anticipate and forecast before the price creates the buying opportunity when we're bullish. So again, if you think that this is quarters theory because you haven't got that far in the mentorship, I'm going to counsel you to revisit that while we're on holiday break, and then come back to this and remember that when we go into the teachings in the core content with my ICT grading the price swing. Okay, so we're forecasting a price move higher. So if we're thinking it's going to go to the rejection block, which is what I'm going to use in this example, it could just as well as been the mean threshold or the bottom of the bearish order block. That could be your terminus. That's the end of where you think it's going to go. That's like the safe bet, the bottom of the bearish order block. Mean threshold is a medium type target or objective for terminus. And then rejection block is just to make sure you try to get the best of the move without running out the high. Okay. Now, again, we were looking for this move here anyway, but we're going to err on the side of caution and show you how you can frame it with using the rejection block and not anticipating, obviously we were expecting, but not anticipating the run above the old high, because there's many times that price will fail to go above an old high, but many times it'll go right to the rejection block and offer you the ideal exit. So you have to frame with experience. There's no real science to it, folks. That part is an experience thing. It's a knack that you get over decades of doing it. Now that's going to sound like, oh, come on, I need a silver bullet, Michael. What I'm going to show you here is enough, and you'll see quickly that it's plenty of opportunity. So with this range in mind, I'm going to add the grades of my price swing from here up to the rejection block. Let's do that now. So here is the buy program, and here is the first grade at 25%, 50% grade, 75% grade, and then finally terminus here at the rejection block. Now on this time frame, it's not terribly interesting, but if we drop back down into that 4-hour chart as we were looking at in our last slide in the previous lesson, let's do that now. All right, so we have our chart trained in on the 4-hour chart for euro, and again we're assuming that this is the beginning of the buy program, and then we have the market breaking market structure here, and then we create an imbalance right there. So that's a buy side imbalance, sell side inefficiency. So when it goes above this high, that is a change in the state of delivery. What is it doing? It's running to buy side liquidity, then it runs up, fails to get above this high here, but then trades lower back into the imbalance here and back into this area of old order flow. This is your breaker. It trades down to it here, but we can anticipate a new buying opportunity in and around that 25% grade. Okay, so all I did was taking a fib from the low here up to the projected rejection block. So that's the range I'm working within. It's an unrealized range. In other words, at this point here or even here, it hasn't traded there. And even in this example in fractal, you can see that it didn't actually trade up to the rejection block. It went to the mean threshold. and then here's the bottom level or low of that bearish order block on the daily chart. So there's our three levels here, 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 and here. So you can see how the market traded respectively. But look what's happening a little bit closer. When the market retraces lower back into this old area order flow and comes back in contact with a bullish order block in the form of a breaker, that's this last up close candle. It's filling in this imbalance here, trades down to it here, and then what does it do? It changes its state of delivery. What is it changing to? A run on buy side. Whereas it was running here on sell side, it hits a level that would constitute a potential change in the state of delivery. Why? It's mitigating at that price point because breakers are mitigation. What does that mean? Anything that was held short from here that was not taken off prior to this run here, institutions will be allowed or permitted the opportunity to mitigate that loss. Now, they may not get out even. They may not make a profit. It's not important for that to occur. It's just to reduce the overall exposure and risk and clear their positions at as close as they possibly can to the point at which that would be the minimal, not exiting their positions at a maximum loss or while it's running away from them. So we have mitigation here after rebalancing the buy side imbalance here with the bullish breaker. Once it hits that, then we can anticipate. Now here's where tape reading comes in. When I look at things like this, and it happens on a 1 minute chart the same way, folks, it's not just a 4-hour chart. It's a phenomenon that repeats over and over again once you understand what the draw on liquidity is. The assumption in this example here, in this teaching, is the rejection block is the draw. Now, I had the benefit of having hindsight in front of me, and still, with the hindsight benefit, I did not frame it where I used the best example with the rejection block getting the high. But with the mean threshold of the bearish order block, look at the bodies of the candles respecting that mean threshold. And in this darker line here, extend that out in time, that's just the bottom end of the bearish order block or the low. Okay, so you can see there's the difference between all three of those PD arrays. But using the draw on liquidity that would be ran to, which eventually it was, but not in this study, it did get to the rejection block and went higher, obviously, but as long as it's moving in that direction, that's order flow. Okay, we're staying with that narrative until something obviously tells us differently. It ain't going to go there. But 25% of that grade, what does that mean? From the low up to that rejection block, we split this up into equal parts, and you do that with a fib. And the way you can do it without having to fancy dance your fib is do a low to the rejection, find the 50% level, and draw that out here. Then pull your fib from the low up to this level here, and then it'll create a higher 50% level, which will be right there. Then drop a line there, and then drag that fib back down, and then pull it from the rejection block to here, to this 50%. And what that'll do is give you a halfway point between this level and the low, and that'll be here. So 25 is 50% of this and this. 50 is half of this low and the rejection block. And 75 is half of the midpoint or half of the projected range from low to rejection block. High or rejection block to midpoint, you'll get to 75%. Okay, so there's your grading of a price swing. Now by itself, you know, people see this and what I'm about to show you, and their jaws drop. They're like, wow, this is crazy. You will not know how to do this by watching just this video. You need all the mentorship for you to know this. And you can see by watching my analysis and what we were expecting for Euro, how all this dovetails together. So at the 25%, we see price trading down below it after it trades above it. Trades to a bullish breaker here. And then we have what? Displacement. We have an imbalance right there. And notice it goes here and starts to trade back down. At the 25% grade, and it goes into consequent encroachment of this buy side imbalance, sell side inefficiency. At this point here, has it fully taken buy side liquidity out? No, it hasn't even gone above this high yet, nor has it gone above this high, leaving relative equal highs. So when this retraces down like that, we are not looking at this to completely collapse. We're looking for it to come back down into this buy side imbalance, sell side inefficiency. So what's happening here? The buy side is changing its state to sell side, going into an old imbalance where it was buy side previously. So what is this lesson showing you? It's the changing of the state of delivery. This is where the opportunities form algorithmically. The buy side here, in other words, basically think of it like this. I'm going to try to talk where we're just talking about up and down. All right. Think about that paint roller analogy I use all the time. When the paint is distributed on the up roll on your wall, price is being offered on the upside. But at some point, it's going to need to come back down to rebalance areas where the paint didn't really go well on the wall. There'll be little pockets there where the paint wasn't evenly distributed. That's what's happening here. So they're rolling that paint roller back down on the canvas of this chart, only to get to an area where there was richer delivery of paint with this candle here. When it happens, once it does that, that change in the state of delivery sets up the opportunity for new buying, because it's filled in an imbalance, and also it's occurring around 25% of the grade of the forecasted price range that should deliver. We don't know, like we're showing here, we don't know for certain it's going to hit this before it goes lower. We don't know that, but it's not necessary for it to hit that to find opportunities. Watch what I mean by that. So we have a mean threshold buy side imbalance at 25% grade and buy side liquidity left intact. So we know the price is going to be strongly pulled to the upside. It does in the next candle here. Runs up above it, consolidates. Are we anticipating it failing after it goes above these highs? No. Why? Because our analysis is saying that the draw liquidity is up here. So we don't look at all this in here as, oh, it's going to run above equal highs and then break down lower, like everybody on YouTube thinks. You can talk like me and have things on your chart, but you have to know why I think the market's going where it's going. That's what differentiates us from people that just have a casual exposure to what I teach. So the market does what? It rallies again above this high. Now watch what's happening, folks. This is important. The market trades above this candle's high right there. And immediately it does what? It has a change in the state of delivery. What is it doing? It's offering sell side again. It's going down. What is it doing? Is it coming all the way back down here to run this low out? No, it's not necessary, because this low has done something at that 25% grade. It rebalanced and then expanded up and ran buy side liquidity. Not fully running to this level up here yet, or even close to it. So when it starts to dip back down in here, what are we looking for? It's running back into old area order flow, which is this last down close candle right there. Okay, this down close candle right there is a propulsion candle. The market trades back down into this candle here and creates an additional propulsion candle, which is bullish, basically trading down into a previous down close candle. So what we're seeing here and what we're expecting is bullish institutional order flow. That means all down close candles, if they trade back down into them, they should support price and go higher. Every up close candle, which we don't have anything over here in this part of the price action, but if you scroll back, you want to see how price runs through old up close candles, which is breaking bearish order blocks. Okay, again, it's not every up close candle in a swing high makes a bearish order block, not for a short. Sometimes it's just a way of measuring order flow. And what I just dropped there was a heavy piece, so make sure that gets in your notes, because you'll hear more about it when you get into charter membership. But we have the market trading at this level here at the order block, and propulsion candle, another propulsion candle, and then rallies up, creates an imbalance right here. Now, notice what's occurring here, folks. This is one of those aha moments. So this imbalance here, does it need to be rebalanced? In other words, does it need to see price come back down here? No. And here's why. Here's where algorithmic theory comes in. At the 50% grade of the potential price swing that we're forecasting, this is generally where we consolidate. It can consolidate longer than it did here and just run out a short-term low or altogether continue. This is where we generally see a run on stops at about the 50% level. If there's an imbalance, they tend to leave those imbalances open. Now again, I just dropped something very heavy. Why would they want to leave an imbalance here just below the 50% level or 50% grade of the projected price swing that we're looking at? Because this is going to act as a breakaway gap or measuring gap. You want to see these things left in price. Now, if you think about how sometimes in my commentaries I'll say, it's better if they leave this area open and don't rebalance it. Oh, light bulbs are kicking off now. Yeah, we're getting to the good stuff. This imbalance should be left intact when we get close to that 50%. Now, if there is no imbalance and there's a short-term low, then around that 50% level, we could anticipate it dropping down below a short-term low, which could have been easily this one, and then that would be a buying opportunity. But if we have an imbalance below the 50% level, I tend to like to see these stay open. Now, that does not mean that it's always the case. Sometimes it will trade back down there. But